how dumb did you feel? I felt so stupid. All these tokens, minting, billionaire. And I just sat on the sideline. To your point,
Same.
Brad, it made me feel so stupid.
Hey guys, welcome back to Library of Wealth. Today we have Chamath giving us his prediction for the current market. The Federal Reserve is focused on keeping inflation under control, which is making investors nervous as the US economy gives conflicting signals about growth in the market. While you might expect more discussion about the Fed holding off on raising interest rates, all indications are that the Fed will be less reactive to markets than in the recent past. Chamath reveals something now that may be unsettling to some, but he talks about the 4 big companies that are essentially keeping the market afloat. But that could also mean that because of exactly how much they control and the numbers we're seeing, that the market has already crashed. Make sure to stay till the end of the video to hear what Chamath's prediction for the current market crash, inflation, and how this recession will affect the financial markets and what's coming next. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
You can correlate these kinds of governance overreaches with zero interest rates. That dog doesn't hunt when rates are at 4 or 5%. I don't care who you think you are, but when you try to go public in over the next 4 or 5 years, if rates are sustained, 3, 4, 5%, that will be the check on all of these people's overreach, because you will have, liquid alternatives that on a risk-adjusted basis seem better. And when rates are zero and everybody was forced to own tech, we all gave up our standards. We all stopped saying, the things that we used to think were important before, like one person, one vote, a check between the board and the CEO, a check between the executives and the shareholders. It all went out the window.
No discipline, no hygiene, right?
Because when interest rates are at 0%, you have to remember, right? How does the structural basics of the financial markets work? It is meant to make money on behalf of every single entity and person and thing in the world, from a pension fund to a university to a research lab to a government to an individual. But in that ability to make money, when we took interest rates to zero, 40% of what we all used to own, bonds, yielded nothing. And so we just completely whipsawed to the other side and said, we need to own anything that grows. So tech got a disproportionate amount of attention, but in that we lost our standards. And then, at the 11th hour, it's like there's a tendency to just capitulate and say, okay, forget it, I'm in. And that's when all the money gets torched. In the last 20 years, we blew through a debt to GDP that was, I think, 57%, and it basically doubled. And so, David, to your point, when we wanted to feel prosperous, what we did was we financed it. Right. We went out and we, put out a ton of debt in order to make sure that our entitlement spending or our defense spending or whatever the things were that we needed as a population to feel like we were growing and moving forward as a society we had. So that is the practical nature of what happens. And look, a lot of people think that there is some upper bound to debt to GDP. And I'm actually of the opposite view, which is I think that, the quote unquote invisible hand justifies us moving debt to GDP to higher and higher rates. So the first time the United States went past 100%, we thought it was the end of the world. It turned out it wasn't. We'll eventually go past 200. Somebody will clamor and, be anxiety riddled, but they'll take some SSRIs. They'll be okay. We'll keep moving forward. Then we'll get to 300%. We'll keep moving forward. So we are in a debt spiral that is a feature, not a bug, of how democratic societies work. As a companion to that, I do agree with you that taxation kind of is a pendulum. It ebbs and flows. And, we're in the part where it's going to go higher before it goes lower. In the beginning of this fall, I was in the Middle East and then I was in Asia. And they have very different taxation schemes, right? And many of them have zero corporate gains tax and, sometimes zero income tax. But then the opportunities for them to be able to invest and drive returns is also commensurately lower, meaning there's not as much alpha in most of the opportunities that they see. Whereas if you go to California, you have to pay 60% tax, but then, you could be an angel investor in Uber, and all of a sudden take 25,000 and turn it into 100 million, which is ungodly. It's incredible. So I think that, in my opinion, actually, like there's actually this beautiful symmetry where even if taxes are high, your earnings potential is commensurately higher, such that the net that you're left with is the same as if you were in another place where taxes may be zero, but you're just not going to get exposed to the same ways to make money. And I think obviously there's corner cases where that's not true, but I don't think sweating taxes is a really important waste. It's an important way to spend somebody's time. I just think it doesn't matter. There was a point in 2016 and 2017 where you literally could not give away Apple stock. And the big turn of the dial, and some say it was Carl Icahn, who knows, was this theoretically this famous dinner that Carl Icahn had with Tim Cook, where he laid out a plan. And it's like, listen, you need to start managing costs better, managing OpEx better, return a ton of cash, buy back the stock, and you'll be a darling. And Tim Cook was rewarded. And he's been rewarded with an incredibly performant company. And so, Google is slowly inching towards that plan. Microsoft is in that plan. And so the only big four horsemen that hasn't really gotten the script yet is Meta, but they will. We're just debating when. And so there's a perception that, Meta will copy what the rest of these big guys do. But these other long tail companies, the headwinds are just greater. And so when you don't have a company that can be broadly owned by intelligent, thoughtful investors, that's a headwind, right? When you give nobody votes, that's a headwind. And so that's why you see a company that's continuing to grow impact, not being able to translate that into economics. And if I were the board of that company, that should be a wake-up call, because eventually that'll flow into the morale of the employees and the ability to retain, and then the ability to invest in the future. And I think the simple answer is enough with all these, gymnastics around control. If you looked at Elon, the most incredible thing from day one was there's common stock, and his whole thing was like, I'm just going to do the best. And you know what? If I'm not the best, I'm going to be out.
He literally said, if you guys want to vote me out, vote me out.
Vote me out. He's never, ever played these games. So in this funny way, control is a symbol of a lack of ability to run the business. Masterful mastery of a business, you can translate that to being, I'm just going to have common stock. Warren Buffett made this very famous bet in 2000. It was him versus a bunch of hedge fund managers, and they were able to pick a basket of hedge funds. And he said, I'm not even going to pick myself. I'm going to pick the S&P 500 and the low cost ETF, the Vanguard ETF. And he said, we'll check in like 20 years later. Anyways, the punchline of the story. Buffett won. He won like $1 million that he donated to charity, and these hedge fund folks lost. Time and time again, the smartest investors in the world, i.e. guys like him, have shown us that the most predictable way to make money, if that is your goal, is to own the S&P 500, which is, a dynamic index of the 500 best companies in the world. So there are these people doing all the hard work for you, and they have very strict criteria of who's an S&P 500 company or not. Now, yes, if you cherry pick other companies that are not, or you concentrate in some, will you generate better returns? Absolutely. But systematically over time, that thing has lurched forward at 8% a year, 9% a year. If you invest dividends, you can approach 10% a year. And so if you really want to just grow your wealth, that's a very simple, steady Eddie way to do it. And to take a small amount and then go and, experiment with it to learn makes sense. But I think it's important to make sure you're going there eyes wide open to try to actually learn.
Chamath has been pretty accurate, even predicting back in January the current crash and recessionary climate we're seeing now, and we'll see how that's going to affect the stock, crypto, and capital markets over the next few months. What do you think about Chamath's take on the current market? Comment down below. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.